So today we're going to continue building the valuation model for McDonald's. So where we left off in the last class is we had created a forecast of 6 years worth of financial statements, which gave us, 6 years worth of free cash flows and CFIs. So today what we're going to do is we're going to take that forecast and we're going to turn it into an enterprise DCF valuation and an economic profit valuation. So starting out, what we're going to do is we're going to follow the methodology that was talked about in lecture note 2 a long time ago. And in lecture note 2, I had mentioned that this was an important page because this represents sort of McKinsey's process for doing enterprise DCF valuation, which we're going to replicate here in our model. And this ties into Modigliani-Miller, so it has the 4 major sections of the valuation that we're going to do. It has the operating value plus the non-operating value is enterprise value, and that's going to equal the debt and equity value. So with that in mind, to get started, we're going to go to our model, and I'm going to create a new tab by hitting the plus button on the far right. And I'm going to rename this tab the DCF, or discounted cash flow, valuation. Right? And I'll make this a little bit bigger so you can see what I'm doing. All right. So I eventually want to print this out on one 8.5 by 11 page. So I'm going to actually have it go down the rows as opposed to across the columns. So let's start out with the operating value. So the key number for operating value is free cash flow. And the first year of our forecast period, I'll get out the CFI, is 2015. Right? So what I then want to do is I want to take, we have 6 years of forecast, so we're going to do 5 years of defined period, and then the 6th year will be the start of the continuing value period. So 2015, again, I'm using a relative reference. I just chose 2015 off the CFI page as the first year. You can choose any 2015. But the key is equals that plus 1. And I want to basically copy that down to 2019. So those are my 5 years of forecast for the company that we're going to do the valuation on. And what I want is I want their free cash flow. So for 2015, we have a forecast for free cash flow off the CFI. So equals, from my CFI tab, 2015 free cash flow, which is after goodwill. So H12. And I'll format this to 1 decimal place, just make it a little bit easier to see. 2016 CFI free cash flow is I12. 2017 free cash flow is J12. 2018 free cash flow K12. 2019 free cash flow is L12. So HIJKL. Okay. Now the next thing I need to do is I need to put these in present value. So I'm going to multiply these by the discount factors, and the discount factor is 1 divided by 1 plus R to the n. Okay, so in this case, what I'm going to do is equals 1 divided by left paren 1 plus, and the R is the WACC. So I'm going to go to the assumptions page. I'm going to click on the WACC. Now when I copy this down, and I'll make this 4 decimal places just so it's a little bit easier to see. I want to make that an absolute reference to the WACC, so $B, $4. I'm going to copy this down for all the years. And again, it's 1 plus R, so in the second year, it's 1 plus R squared, so that's shift 6, which is called the caret key in Excel, to the second power. 1 plus R cubed, caret 3. 1 plus R to the 4th power. And 1 plus R to the 5th power. Okay. So those give me the discount factors, which then gets me my discounted free cash flow, which is the present value it gives me a present value, which is the free cash flow times the discount factor. Okay. So again, present value is cash flow divided by 1 plus r to the n, or t. So what we've done is, here's my cash flow, 1 divided by 1 plus r to the n or t, multiply the two together. This is the cash flow divided by 1 plus r to the n or t. So again, it basically just gives me the discounted free cash flow. Right? So when I sum those up, that gets me the operating value of the first 5 years. So what we're saying is, if those free cash flows come true, then McDonald's is going to generate $22 billion and change of value in present value terms, selling burgers in its stores for the first 5 years. That's what we've basically done. Okay. Now, McDonald's will continue after 5 years, so we're then going to get into the continuing value period. So continuing value for McDonald's is the value of year 6 going forward. Well, in the last lecture note, lecture 6, this is what we said. We're going to use the key value drivers formula for the continuing value of the free cash flows. Okay, so the operating value of cash flows is the key value driver formula. It has 4 elements to it. No plat in T plus 1. For McDonald's, that would be the 6th year, or in this case, T plus 1 is always you do 1 extra year. So in that case, 2020, no plat. RONIC is the 2020 ROIC. G is the very long-term G of the company, long-term growth and cash flow. And WACC is the cost of capital. So those are the 4 elements that we will need in order to do the continuing value. So what I'm going to do is I'm going to put those 4 elements on the assumptions page, because again, I don't want to change assumptions anywhere in too many places in the model. So we said we're going to limit it to one of these 2 pages. So I need those 4 numbers. So I need my continuing value, no plat. I need my continuing value, no ROIC, also known as RONIC. And then I need my continuing value G. Those are the 3 things that I'm going to need to complete my model. So my continuing value no plat is going to equal, from my TII, my 2020, so that's row 4, is no plat, 2020 forecasted no plat. Right? My continuing value RONIC, or ROIC, RONIC stands for return on new incremental capital, right, is going to be equaling to my 2020 ROIC, and this is key, using the BOY tab. So I go to EPBOY 2020 ROIC after goodwill. We always include goodwill in our valuations. So that's row 15, column L. So L15 off the BOY. Right? And then I need my continuing value G, which I'm going to start at 3%. Right? And the reason I'm starting at 3% for my G is that generally over a very long period of time, companies should grow their cash flows at about the rate of the economy. We're going to assume U.S. European economies generally about 3%, very long term. You're going to primarily be doing U.S. companies. So McDonald's, where most of its business in U.S. and Europe, we're going to say is around 3%. We can always adjust it later. But somewhere a mature growth G is around 3% for U.S. and European companies. So call that 3%. All right, so now we have enough data points to do our continuing value. So again, putting in this formula with the correct order of operations equals left paren from the assumptions tab, my continuing value no plat times left paren 1 minus the CVG divided by the ROIC, right paren divided by left paren WACC minus G. So somewhere around 72 billion and change is the continuing value for McDonald's, right? Somewhere around, is that the one you want?
No,
Oh.
the equation.
So that's the equation. It's basically this equation, right? So, NOPLAT times 1 minus growth over ROIC divided by WACC minus G. So, that tells me the value of McDonald's for the year 6 to perpetuity. All right? But the continuing value equation, which is the growing perpetuity equation, includes a discount factor. So it's actually discounting that to a present value, but the present value is as the beginning of the year of the continuing value, which means it's the beginning of 2020. So I still have to bring it back to today. Okay? Now, this tells me the value as of January 1st, 2020. And today, I'm doing a value. Discount factor is usually end of year to beginning of the year, which is basically the same as December 31st, 2019, for all intents and purposes. So what we're going to do is we're going to use the same discount factor to discount this cash flow back to the present value. Right? Now, again, it's very important that we want to use the 2019 discount factor, because if we use the 2020 discount factor to the 6th power, what we would be doing is we'd be double discounting 2020, which is a common mistake that people make, and you don't want to make it, because the growing perpetuity discounts 2020. Okay, so we don't have to discount 2020 again. We just have to take the 2020 value, move it back 5 years. That's why we're using the 2019 discount factor. Okay, so again, in present value, the continuing value is worth the free cash flow times the discount factor is worth another a little under $48 billion. So therefore, the operating value of McDonald's equals the first 5-year defined period plus the continuing value period, or a little over $70 billion, 7182.19. That is the operating value of McDonald's, assuming our forecast comes true. Right? Now, following Modigliani-Miller, operating plus non-operating equals enterprise value. The good news for you is that in our TFI, we had actually organized the TFI so that the non-operating assets are listed right here. Okay? So those are the non-operating assets that we have to value. So what I'm going to do is I'm going to refer to, starting in row 13, equals from the TFI, the 3 non-operating assets. Excess cash, miscellaneous non-operating assets, and long-term investments. Okay. Now, here's the thing. Excess cash, I want to use the current cash of the company. That's already in a present value. So equals, from the TFI, the 2014 excess cash balance, which was the last reported year. The non-operating assets equals, from the TFI, 2014 non-operating value of the non-operating assets net of the non-operating liabilities. Long-term investments, TFI, equals 2014 long-term investments. Those are already in present value, so I don't have to discount them. When I add the operating value to the non-operating value, I get the forecast of the enterprise value. So I'm going to sum those up from D11 through D15. That gets me the forecasted enterprise value for McDonald's. Now, the one adjustment I want to make to this forecast, McDonald's doesn't have a value of its long-term assets, which is basically like equity investments in other companies. But let's assume that McDonald's actually made long-term investments and they're not worth zero, right? Well, the problem that we're going to have with the reported accounting long-term investments is they're going to be given to us at book value. And what we care about is the market value. So what I'm going to do is I'm going to come over here to the Assumptions tab, and I'm going to create a new assumption called the price to book multiple of long-term investments. and I'm going to make that yellow. And I'm going to start it out as a 1. So basically, if I use a price to book multiple of 1, it means the long-term investment's market value equals the book value, right? But let's say a company invested in something that's worth a lot more. I just make the price to book multiple more representative. Could be 5, could be 6, or it's worth less, could be 0.8. But basically, it's a way of adjusting the accounting value of the price to book multiple to a more realistic market value. So what I'm going to do is I'm going to come back here. I'm going to take my long-term investments, and I'm going to multiply it by, from the assumptions, my price to book multiple. Now it's 0 for McDonald's, and it doesn't matter, but we're building a reusable model, so it may matter for the companies that you're doing the group project work on. Okay, questions about what we just did? All right, so again, following Modigliani-Miller, the enterprise value also equals the debt and the equity. What we're trying to get to is a common equity value. So what I need to do is I need to take all of the debt and non-common equities, pay them off, and an equity, common equity, is a residual value. So again, this is where TFI helps me, because on my TFI, I listed all of the debt and equity items that are owed. So the people that I had to pay off, I'll start paying off. So from this enterprise value, I pay off the retirement-related liabilities. I pay off from the TFI the interest-bearing debt. I pay off the preferred stock, and I pay off the minority interest shareholder. Now, I don't pay off the common equity because I'm actually solving for what's left goes to the common equity value, the residual. But those are the 4 people ahead of the common equity holders that have to get paid before the common equity holders get paid. So again, the 2 interest-bearing debts on our TFI, pension, long-term retirement liabilities, interest-bearing debt, short, long-term debt, bank debt, bond debt, etc. Preferred shareholders get paid, minority interest shareholders get paid. What's left? Common shareholders. Now, what do I owe these people? Again, right now, the 2014 amount that I owed is already in the present value off my TFI. 2014 retirement, G14. 2014 interest-bearing debt, G15. 2014 preferred shares, McDonald's doesn't have any, but that would be G17, and minority interest, G18. After I pay all of those people off, I'm left with a common equity value equals the enterprise value minus the sum of those 4 things. 55,834.26. Okay, so we're basically paying off these 4 liabilities and non-common equities. Now, the next thing I'm going to need is, if I know the shares outstanding, then I can get a forecasted share price. So I just divide by shares outstanding equals share price. Now here's the thing. I don't want to put the shares outstanding on this page because that's going to change company by company. Right? So I'm going to put that as an assumption. So I'll copy the shares outstanding. I'll put it in the assumptions tab, the next assumption down, and I need to go get the assumptions of the shares outstanding for McDonald's. Now in Bloomberg, the screen to get that, you look up the company, in this case McDonald's, and then you type in DES for the security description, and on the first page of the security description is the current shares outstanding for McDonald's. So 961.1 is their last reported shares outstanding. So 961.1 is the shares outstanding we use. So back to my DCF valuation equals, from assumptions, 961.1. Share price equals common equity value divided by shares outstanding. That works out to 58.09 a share. Questions about what we just did? So at about $60 a share right now. And oh, by the way, McDonald's today is trading at 98. So obviously the market's a little bit more optimistic than what our spreadsheet is initially saying. Right, so again, we take the operating value is the first 5 years plus the continuing value, add in the non-operating assets to get the enterprise value, pay off all of the non-common debt and equities. That gets us an equity value divided by shares, share price. Right? Relatively straightforward enterprise DCF methodology. Now, I mentioned to you earlier this semester, we're going to do 2 valuations of companies in addition to an enterprise DCF. We're also going to do something called an economic profit or an EVA-based valuation. And they have to match 2 identical valuations. So company doesn't change its values, we change methodologies, but we're going to do an alternative methodology to get to the same answer. Now, when we went through the lecture notes and you read in the book from McKinsey, they gave an example of this. And the example of this in lecture note 2, using Home Depot, basically said the only difference between the economic profit valuation and the DCF was how operating value was calculated. Everything else was identical, but the only difference was calculating the operating value. So what we're going to do to make our lives a little bit easier is we're going to take the tab that we just created and we're going to clone it. So in Excel, if you hover over the tab name, right-click with your mouse, move or copy, create a copy, scroll to the end, move it to the end, hit OK. And that would have cloned that last tab. And then we're going to rename that cloned tab by clicking on it, the EP for economic profit valuation. So now I have 2 identical tabs. I have my DCF tab and I got my EP tab. Okay. So what's different about the economic profit valuation? So I'm on the EP tab, same period of time, but instead of forecasting free cash flow, we're going to be forecasting economic profit. So clear those cells. And when we discount them, instead of getting us a discounted free cash flow, it's going to get us a discounted economic profit. Economic profit is the change in value. Right? So free cash flow is the actual amount of cash that we generate during a period of time. Economic profit is the change in value of the business during that period of time. So the way economic profit works is there's 3 parts to it. It's the change in value of the company's assets during the first 5 years, the change in value of McDonald's year 6 into perpetuity, and since we're looking at the change in value, we also add in the starting invested capital. So basically you take your beginning invested capital, you look at the change in value, and that gets you the overall value of the company. That's the EP methodology. So to get the economic profit year by year, starting in 2015, we have a tab that forecasts it, economic profit. Very important, use the BOY tab for economic profit. Don't use the EOY tab for this valuation. So economic profit based on beginning of year, BOY. So in our EP valuation for 2015 equals EP BOY, and we want to use the economic profit after goodwill. So that would be the 2015, so G23 off the BOY tab. 2016 off the BOY tab would be H23, economic profit forecast. 2017 is the I-23, 2018 J-23, 2019 K-23. So G, H, I, J, K. Again, BOY. Don't use EOY. Same discount factors because it's the same cost of capital. That's the change in value the first 5 years. Then I need the change in value of the continuing value. It's going to be a different formula for the continuing value equation. I add that to the operating value. Add that to my beginning invested capital. I get my operating value. My beginning invested capital or starting invested capital equals, from the TFI, 2014 operating invested capital, including goodwill. So G7. So the idea is I start with $27 billion worth of invested capital in my business, and then I'm going to add or subtract to that value to get to my operating value. And my operating value is going to be the sum of three things: the first 5 years, the continuing value, and the starting invested capital. So right now, 438.5. So what I now have to solve for is the correct continuing value. Now here's the thing. I know that I have to get the same value, so I know that the operating value eventually has to be that number. So as a way to make sure I have it right, what I'm going to do is I'm going to take from the DCF tab the operating value, and I'm going to subtract from the EP tab the operating value. And I know that difference has to be 0 to have a correct answer, because my valuations have to match. Which also means that I know the answer to this question. I know what that needs to be. It needs to be that number. All right? But plugging in that number is not a correct answer. You'll get no credit for that. All right? What you have to do is you have to solve for it and make sure that you get them to balance. Matter of fact, this is your final exam. Part 1 of your final exam is I'm going to give you a set of company financials, and you're going to have to do a DCF and an economic profit value, and you got to show me that they're identically matched. That's half your final exam right there. Right? It's doing exactly what we're doing here today. So, here's what I want to do. I want to take my continuing value, and I want to use the continuing value for economic profit. Now, again, in the book, most recent lecture note, this was the formula for free cash flow continuing value. When McKinsey rearranged it, this was the formula for economic profit continuing value. So we had to put this formula with the correct order of operations into our Excel model. Right? This is actually going to be the toughest part of your assignment here. Just making sure you put it in right. So hopefully we'll get it right in the first try. If not, we can manipulate it. But the one thing that's new in this version of continuing value is economic profit in T+1, which is our 2020 economic profit. So what I'm going to do is I'm going to go back to the Assumptions tab, and I need a CV economic profit, which is going to be my, from the BOY, again we're using beginning of year, 2020 economic profit after goodwill, L23. Got 2 decimal places, 1 decimal place. So I'm now ready to start. I got the 5 items, these 4 plus this one, to create the continuing value economic profit equation using this formula. So see if we can get it right in the first try. Economic profit T+1 divided by WACC. So equals left paren from the Assumptions tab, CV economic profit divided by WACC. Right paren. Plus left paren. No plat. Continuing value no plat. Wait a minute. That doesn't look right. I took the wrong cell here. B4. There we go. So no plat times left paren. It's going to be the G. So CVG divided by ROIC. Right paren. Times left paren. ROIC minus WACC. ROIC minus WACC. Right paren. Right paren. Divided by left paren. WACC times left paren. WACC minus G. Right paren, right paren. So, if I did it correctly, it looks like I did, my continuing value is 47,731.7, and notice the difference between the 2 models, 2 spreadsheets, 0. There is no difference. And that's mathematically what I wanted to illustrate to you, is that's what I said. If you change your methodology, you got to get the same answer. all right? Because the company's value isn't changing because you decided to value them a different way. And that's what we're proving here. And oh, by the way, it's not within a dollar. It's exact. And that's the point. If you use BOY invested capital in your ROIC and your EP, you get an exact match. If you use end of year, or if you use an average beginning and end divided by 2 invested capital, you get close. Right? I did it using BOY because I wanted to show you actually do get an identical answer. Yes? So this was, for those of you watching on video, this is the right formula with the right order of operations. Okay. Questions about what we did? All right. So what we've done is using our forecasted financial statements, we created forecasted cash flows and economic profits, which have given us a forecasted share price. Right? What we're about to do is, in this class, you will always do 2 valuations of any company. All right? So we're now going to do valuation number 1, which we're going to call the as-is valuation. And the point of an as-is valuation is we're going to value the company based on its current share price. We got to get really close, right? So the idea is, in an as-is valuation, what we're really trying to understand is what assumptions must the market be using to justify the current share price. That's the whole point of an as-is valuation. It's not whether or not you agree with that share price. Because whether I agree with McDonald's trading at $98 a share, which is where they are right now, that's the actual share price of McDonald's today. So it's not whether I like it or not, that's what people are actually paying. So we're trying to figure out is what assumptions, cash flow assumptions, have to be made to justify that price. That's what an as-is valuation is. Valuation number 2, what I'll call the final valuation. The final valuation includes our opinion. We develop a point of view for what we think the assumption should be. That's going to create a different stock price. The difference between our opinion and the actual gives us the buy, sell, hold. So when we change the assumptions to what we think are realistic, and maybe we agree with the market, we don't change it at all. If we're within 10% of the current share price, we call it a hold. Because basically, we're saying it's within a trading range. If it's more than 10%, based on our assumptions, then we call it a buy. If our target share price is less than 10%, we call it a sell. Buy, sell, hold. That's exactly how the analysts are doing it. So essentially, that's what we're about to do. We're going to basically create the as-is valuation for McDonald's, where we are going to try and replicate a share price very close to $98. Right? And by very close, I mean within $1. We're going to be really close. So, how do we do that? Well, first of all, we got our forecast for share price down there at 58.09. So what I'm going to do is we're going to go to the ratios tab. And because I'm going to be jumping around a lot, I don't want to keep going back and forth to that tab. So what I'm going to do is I'm going to create right here a forecasted share price right here in this tab. And I'm just going to refer to the one off the DCF valuation. But that's at 58.09. Okay. So basically, I'm just replicating what's on there. So when I change the ratios, it will change the price. Right? So again, here's how the model works. Right now, the model says McDonald's is growing or shrinking at 2.4% every single year. So what if they were to grow at 4% a year? Well, that would get me to $80 a share. So obviously, I'm getting closer. So that's the idea. We change the ratios to change the forecasted share price to get really close. That's the idea of the as-is. Except here's the deal. I don't know as much about McDonald's as certain people on Wall Street. So who are the certain people on Wall Street that should know a lot better of McDonald's that are forecasting their share price? Who would they be? I'm sorry? It's the sell-side analysts. Okay? And if we go to Bloomberg, the sell-side analysts, under the Earnings Estimate Overview, EEO, have created a forecast for McDonald's going forward. And that's the thing. these people who are following McDonald's for a living professionally probably are going to create better forecasts for McDonald's than what we forecast. So that's the idea, is we're going to start with using the consensus estimates when we build out our model. Now, here's the thing. What you'll notice about McDonald's, this is true for just about any company, is the sell-side analysts are actually projecting out 5 years. However, you notice the first 2 years are more heavily forecasted than the third forecast year, right? And the reason is because every time you put a forecast out there, you're tracked. So when you get to years 3, 4, and 5, it's much less certain. There's much more standard deviation and variance in those future forecasts. And I don't want to be tracked looking like a fool because I put a number out there and then it looks wrong. So generally, the first 2 years are more heavily forecasted. By the time you get to years 3 or more, they're more lightly forecasted. And again, you can see this. There's 22 analysts predicting sales for the first 2 years. Only 5 are sticking their necks out for year 3. Now, it doesn't mean they don't have one. They have them for year 3. They're just not putting it out there for the public to see. All right? So what we're going to do for our benefit is we have to create the first 5 years ourselves. So rather than creating all 5 years, we're going to use the first 2 years of consensus to make our lives a little bit easier. So here's how we're going to do it. We're going to go back to our model on the Assumptions tab, and I'm going to create equals previous year plus 1 and plus 1 more for a future year for 2015 and 2016. Right? And again, I'm using relative references if I ever change this last reported year. The numbers that matter, and it's hard to see on the main screen here, but the numbers that matter in our model are these 3. Revenue growth rate, EBITDA, tax rate. Those are the 3 most important items to our free cash flow valuation forecast. That's why they're in light gray. And that's where you're going to spend most of your time. Is trying to figure out those 3 numbers. Now, the balance sheet, which is capital expenditures and change of working capital, that forecast is taken care of down here because we tied everything to revenue. So if you believe that the productivity of the company changes, you can change that. But by leaving productivity constant and tying it to revenue, then as the company grows, then net PP&E grows. As net PP&E grows, it creates the concept of CapEx. Okay? So in a way, we're forecasting gross investment by leaving the balance sheet constant as sales goes up and down. Now, if you believe that the company won't have productivity that's constant, you can go in here and change those numbers. But what I'm telling you is on Wall Street, most people don't change the productivity that much. And what they do is they tend to focus on these 3 numbers. That's why these are the key numbers. So, tax rate, we're using the average of the last 6 years. That looks pretty reasonable to me, so that's why I'm not going to change that as an assumption. So what I'm really going to change are growth and EBITDA. So here's the thing. What I want off the EEO screen is I want the 2016 and 15 sales to match in my model. So 2015 revenue, 25,441. So sales, 25,441. And the second year, 25,609. Then EBITDA. 2015 EBITDA forecast, 9,006. 2016 EBITDA forecast, 94,44. Okay. So I need, on the income tab, these 2 revenues and these 2 EBITDAs to match. Remember, I can't directly change the income tab, but I create it by changing the ratios. So what I really need to figure out is what's the right revenue growth rate for these 2 years to get those numbers, and what's the right EBITDA margin to get those 2 numbers. So here's what I'm going to do for revenue growth rate. I know that the percentage change in revenue is current year minus previous year divided by previous year. That's the formula. So here's what I'm going to do for 2015. Equals, left paren, current year, assumptions, 2015, minus previous year, income tab, 2014 actual, right paren, divided by 2014 actual revenue, equals negative 7.3%. So what the analysts are actually forecasting is a 7% decline in McDonald's revenue in 2015. For 2016, equals, from the assumptions tab, 2016 revenue minus 2015 revenue divided by 2015 revenue. Try it again. Equals, left paren, 2016 revenue minus 2015 revenue, right paren, divided by 2015 revenue. 0.7% growth. By the way, I need to make those yellow because I'm changing those in the future. So they're basically saying in 2016, McDonald's is going to grow 0.7%. Right? Finally, EBITDA margin equals for 2015 off the assumptions tab, 2015 forecasted EBITDA divided by 2015 forecasted revenue. 2016 equals, from the assumptions, 2016 EBITDA divided by 2016 revenue. So 35.4 and 36.9%. Which, oh, by the way, gets me a share price of $68.28. Questions about what we did so far? Yes? So the 2015 revenue growth rate is assumptions B13, which is the earnings estimate for 2015 sales, minus income G3, which is the 2014 actual revenue, all that in parentheses, order of operations is important, divided by 2014 revenue, income G3. Yes? 2015, which one? EBITDA? That is the assumptions B13, so the 2015 EBITDA forecast, divided by the 2015 revenue forecast, or sales forecast. So that's just the EBITDA margin that Wall Street's forecasting. We're just using that as a placeholder in our model. So if we forecast revenue growth for the next 2 years, and we forecast margins, EBITDA margins, and we leave the tax rate alone, because I'm okay with the tax rate that the model's giving me, the average of the 6 years, then that works out to a $68 share price, which we need to get to, again, 98. Right? Now, this is where a little bit of art comes into the model, because I now have to decide what to do with revenue growth rate and what to do with EBITDA margin to get me closer. Right? So here's where it helps to know a little bit about the industry. This is why we do EICs, for example, and we'll do more of this on Wednesday for McDonald's. Right? But the general idea is that McDonald's is having trouble with same-store sales. That's why they're shrinking. And in general, people are not really driving as much fast food growth as they used to because they're worried about health and health-conscious stuff. That's why it's now being called fast casual. Companies like Chipotle are doing much better because people want like real food as opposed to the beef that McDonald's sells. It's an old Cheers reference. But it's not beef, it's beef. Okay? But that's the problem, is McDonald's like, no, we have real beef, but people are worried about processed food. So long story short, they're struggling with refreshing their menu. That's where they're getting their same-store sales decline. Market's saying they're going to fix it. What are they going to grow at long term? Well, here's the thing. This is why we have a little bit of history as well. So I don't think McDonald's, which has really been struggling with growth, is going to grow that much more in the next 5 years. So let's leave that alone, and I think they're going to struggle with margins. Well, when they started, they were closer to a 35% margin last year. They've actually been improving through some cost cuts. And I think that they're going to be competitive without growing. So what if I believe their margin goes back down to 35%? Well, that gets me to a share price of $63 a share. Okay. Now, I also believe that I need to put in the right cost of capital. So I want to use the current cost of capital for McDonald's. And right now, I'm using an old placeholder cost of capital. So I go to Bloomberg, and I type in WACC, and I get a current cost of capital, and for McDonald's, that's 6.1%. So I put in the current cost of capital, 6.1%, and oh, by the way, that changes my share price to $119.51. Yes? So I changed the EBITDA margin to 35. I think the EBITDA margin is going to be closer to where they are today than the improvements they're making over the next 2 years. I think it's going to regress longer term. That's just my point of view. Yes? In the yellow cells, I'm just typing absolute numbers. But I'm typing it in 2017, which obviously is carrying it forward to the other years because it says equal the previous year. And then, as I said, I updated the WACC. All right, we have the current amount of shares. So the final step is, I don't think that they're going to have a CVG of 3%. I think it's going to be lower. The last couple of years they've been growing at 2%. I'm predicting 1% going forward. So I think in a perpetuity, McDonald's is going to underperform the economy. Right? So I'm going to change that to 2% and see what happens. If I look back at my share price, that works out to $97.47 a share. Now I'm really close. By the way, those are the 3 changes we stumbled into in the last class, and then I got to 98 and I said, gee, that's all I really need to change. So what I've just done for you is created the concept of an as-is valuation. And the reason I say it's a little bit more art because I don't know if exactly the market's using these exact assumptions, but what I know is somewhere around relatively flat growth and somewhere around a little bit lower margin than they have today gets me to the current share price of McDonald's. And that the long-term growth can't be 3%. It's probably going to be a little bit lower than 3%. So that's what I'm trying to do is I'm trying to get a feel for what I think is realistic to why McDonald's is being valued as is. Now, again, it's not whether I agree with these assumptions, and that's important. What I'm trying to do is I'm trying to replicate the cash flows that justify the current share price. And these are assumptions that kind of get me there. Right? And this is what I would call an as-is valuation. So what I'm going to do, I'm going to save this, and I'm going to call this my as-is valuation. If you got to this point, you've completed the first half of the homework. Now we're going to then go to the next step, which is, does it make sense to invest in McDonald's and recommend to our clients that they invest in McDonald's given our point of view? So that's the major difference. When you do the final valuation, you're putting in your perspective. When you do the as-is valuation, you're trying to understand the wisdom of the market, right? And then the delta is between your target and the current is whether or not you advise people to buy, sell, or hold. That's what we're really doing. But it's instructive because what a lot of people do is they go straight to the final valuation. Now, you just put in your point of view and you come up with a value. But I think it's actually helpful to understand what the assumptions have to be today before you put in the final. So as we said, if you work on Wall Street, people will often do one valuation. They'll just go straight to the final. They'll skip the as-is. And what I'm telling you is I think it's useful to do the as-is before you do the final. So baseline it to where the company has to be today, then think about your changes rather than just putting in the assumptions that you want. So that's the process we're going to replicate in this class. By the way, this model is now ready to be used for your group projects because we're pretty much done with the valuation model. We have created a replicable valuation model. What would I need to change? I come here to model data, and using our exported template, I overwrite the model data cell for cell, but basically copy it, paste in my company's data. Then I go to the assumptions, and I change the assumptions. Make sure I have the last reported year in case they have the fiscal year, change the WACC, change the shares outstanding, change the earnings estimates. So essentially, that's what we'd have to do, and that's what we will do when we practice in other companies. But for now, for McDonald's, this kind of gets us there.